And there's been kind of like a lot of deals happening between some of the Bitcoin miners and these hyperscalers to kind of, redo these Bitcoin mining data centers into, AI data centers. And so far what Helios has signed is their full 800 megawatts of approved power has been leased out to CoreWeave, and they're projecting that to bring in 1.2 billion a year in average annual revenues over 15 years at kind of these 90% EBITDA margin levels.
Before we begin, I want to give a shout out to our new sponsor, Value, an AI-powered investment research terminal with prop indices and a high-performing DEX on its own chain. Join its third research competition for a $100,000 prize pool by submitting on socialvalue.com or on BidClub.io, with an additional chance to win another $2,000 every 2 weeks. Welcome to another episode of Bitcast. I'm your host, Jason Kam, aka Maple Leaf Cap. Today is August 18th, 8 p.m. Hong Kong time. Bitcast is being live streamed to BidClub members. Questions are from the members and my own. This is not financial advice. Very important because this time we're talking about a stock. Today I'm speaking with Duncan, the founder of Flood Capital, also an advisor to Delphi, and also currently one of the biggest advocates for GLXY Digital. Duncan, welcome.
Yeah, thanks for having me on. I'm excited to chat.
Yeah, I mean, the Blockworks episode you did with the Rittenhouse guys, it was really good. I mean, it was a great 101 on walking through the high-level thesis. So we rolled up our sleeves and did some digging on GLXY, the stock, and I'm really glad to have you on and kind of talk through some of the questions we have. Let's take through, because I think, in the bull case, let's start with the balance sheet first. I think in the balance sheet, you talked about a $3.3 billion of book value today for just the prop book. Can you kind of bridge me through how you get there? Because the book value is obviously smaller than that, including all the other stuff.
Yeah, so I'm going to share my screen, and Jason sent me over an extensive list of questions before we start, or a couple of days ago. So I've done my best to try and go over all of them in as much detail as possible with some help from Rittenhouse Research. Thank you very much. For the help there. So definitely, this is his Twitter. Give him a follow. I would say that he's leading voice in Galaxy and also just the general AI kind of Bitcoin miner to AI pivot. He's covering a lot of those companies. Also like watching, the big tech companies on their CapEx and CoreWeave. So definitely give him a follow if this space is interesting to you. So in terms of how I'm thinking about kind of like the net balance sheet for investor purposes, you can download this off of this Excel off of Galaxy's investor relation pages. But basically, you have like a consolidated, like net equity of 2.6 billion, of which about 1.9 billion is exposed to crypto. That was of June 30th. I did this math a few days ago, so crypto's down a little bit in the past few days, but
Yep.
Roughly between, they have a bunch of Bitcoin. I know they have some ETH. Then I think like Hype and Sewer are some of their bigger kind of altcoin positions, and then like a pretty extensive venture book with names like bullish on it. So I think they'll see like a big markup on that. So I think roughly 25% is the right number to use, although we might not see that exactly flow through into the next earnings. So that's an additional 471 million. Then they have these outstanding converts, which get counted as a cash cost on the balance sheet for a liability. That's going to convert into equity, so we add that back in. Then you subtract the property, plant, and equipment, which is mostly money that they've sunk into their Helios data center, which we'll get into. So you get to about roughly, 3.2 billion or so on kind of like the net balance sheet, and that's the math there.
Got it. Do you feel like it sort of swung in line with kind of Bitcoin? If I were to sort of heuristically project that going forward, it's like a 1 beta to Bitcoin. How do you think about that?
Yeah, I feel like it has followed the crypto market, but kind of on less volatility. So I would think of it roughly as like 2/3 crypto exposure, 1/3 of cash. And over time, yeah, it's had some aggressive swings, but they've kind of slowly grown it, up into the right as crypto has moved. So, Rittenhouse has this tweet here where they've gone from about $1 a share in 2018, and now it's about $7 or $8 a share now, while also funding, two massive business lines, which is kind of like their crypto business and then their data center business, which we're going to get into.
Yeah. Well, actually that tweet, I don't think it carries out as well as he thought it does, because like Bitcoin from 20, I don't know, it's up like
Yeah, I don't know.
like
Bitcoin's up a lot.
40x. Like
Yeah.
it should grow. They actually underperform quite meaningfully. They outperform
Yeah.
the miners, yes, but
I definitely agree that, versus just holding Bitcoin, you've the balance sheet's underperformed at this point. I definitely think like Galaxy versus Bitcoin now is a lot more attractive in my view, and we can get into that. But I guess when you do look at the other kind of crypto companies, especially on kind of like the miner side, when you're looking to play this AI, this kind of Bitcoin miner to AI trend, you have, so these at the time, Rittenhouse wrote this report. It's really good. You should check it out. It's on his Twitter. You had Core Scientific, who was, basically bankrupt 2 years ago, 18 months ago. And then names like TeraWolf, like Riot Mara, all these guys have had like 300, 400% dilution of shares since 2021. So in terms of like the scope of crypto companies, Galaxy's performed really well in that sense, but obviously pretty big underperformance to Bitcoin. But that can be said about them growing their business and also kind of like rounding out some of the volatility that Bitcoin and the crypto markets have had.
yeah, we're talking about this before this too, which is 700 million of convert debt, two tranches. From calculation, that converts to about. I don't think there's meaningful debenture sort of uplift, so it's kind of like a 30 million shares converted, and I guess I should be using like a 405 million kind of share count going forward. Is that the right math?
Yeah,
Okay.
that seems right. So maybe like 7 to 10% dilution once those convert.
Yeah. Should we project a lot of stock-based comp and inflation to share count going forward, you think?
Yeah, so I think like historically they've grown their share count at like 3% a year. So nothing massive.
Yeah.
Especially when you compare to some of these other stocks. I think like a notable point on this is in 2022, they did do a lot of buybacks when they felt like their stock was
Oh, they
undervalued.
did.
Yeah,
That's funny.
yeah,
Okay.
they actually did in 2022, 2023, around like $3-4. So that was like something nice to see, just relying on the management team to, raise money when times are good and buy back when times are bad and try and kind of round out the volatility of the business. So I don't think many other crypto companies, if any, have done buybacks.
Yeah.
So
Do you recall if they did it under
data
book
point.
during that period of time? You
I
said
don't think it was
$34.
quite under book, but
Yeah.
it was right around book, and then they're obviously like bullish on their business in the future.
Okay. So I get how you get to the 3.2 billion. That's on 400 million plus of share count. But that book value is split between the prop book and the investment bank. And then from the same statement you provided, it seems like it costs about $500 million to run the investment bank. Is that the kind of a right way to think about that?
Yeah, so obviously like their trading and like OTC and lending business are like take some capital to run. So they like utilize their own balance sheet to run that. So I think that's probably the right way to think about it.
Can you break down like the fee stream of that investment bank business and the cost basis?
Yeah. So kind of going in, I can give like a high level overview of the digital asset business. And, I'm assuming that some people who have read or who are watching this have, either seen maybe the Blockworks podcast or read some of my tweets, but just at a very high level, like how I think about Galaxy is you have this balance sheet, which is, net $3.2 billion on like a 10-ish billion dollar market cap. And then you have, the rest of the equity value split between this digital asset business, which kind of includes like trading, asset management, lending, investment banking, and then they have kind of these, growth business lines that we might see expand in the future, which is they have like a joint venture called All Unity, which is like the first fully regulated euro stablecoin. They own a third of that. They're partners with Flow Traders and Deutsche Bank on that, and then stuff like GK8, which is their institutional grade self-custody and tokenization platform. So kind of like these different business lines that could be pretty big in the future, but aren't really showing like immediate revenues right now. But this is kind of pulling a few charts from the Goldman report that they did. So basically at a high level, what has contributed to their revenue over time, this has been kind of their treasury balance sheet. 2024 crypto's up a ton, 2025 crypto's up a ton. That's been a big contributor. Goldman doesn't forecast crypto going up or down in the future, so they have that tapering off, pretty significantly. And then in the future, they have it kind of moving more towards the data center as Helios scales up, but still
for sure talk about it.
Yes, and then still some revenue growth on the digital asset side. So, and I think that they're being, rather conservative here. Obviously, this is a guessing game and takes a lot into account of like, it's very hard to do like a straight line CAGR for these businesses because crypto is so volatile and these revenue streams are obviously extremely correlated on the digital asset side. But, the past 2 years, they've grown it at like 40% a year. And then they expect 12% a year kind of as like a steady state into 2028 from now. So that's like
this is the what I'm looking at 303 million. That's the iBanking effectively side of things with asset management and like OTC.
Yeah. So this is like all of the digital asset businesses revenue.
Okay.
So so the global markets they say is like trading and lending, and iBanking, and then asset management is like their fees there and staking there.
Yeah.
So, yeah.
When I think about that business, because it's interesting, my impression is they do everything under the sun. When there's a deal, they're brokering it, they're charging a fee, they're taking things to public, they borrow, they lend, we could borrow from them. Asset management, it's like a pretty sticky business if you can convince people to give them money. And that all of that is on a cost base blended historically of about 250 million, mostly labor, if I'm not mistaken.
Sorry, mostly
labor, like bodies, like salary, bonuses, and whatnot.
Oh, okay. In terms of costs, yeah. So I think that's I have that later in here, but basically, like the bull case for this business is that they have relatively fixed costs over the past few years between like 200 to 250 million, and then now that we're seeing kind of crypto go more mainstream in the US in terms of regulations, Galaxy's done like a ton of stuff with treasury companies, that and crypto prices are up, that they're going to be able to scale these revenues more aggressively than their costs, and they've invested a lot into like the people and infrastructure around Galaxy. And now, like, this is kind of the turning point of where we should see like big pickups in their margins on this business as they can scale revenue a lot faster than they've made all this kind of investment into the people and talent and infrastructure. And now, like, this is the time where crypto is becoming mainstream and they can really take off on the revenue side.
Yeah. Do you have a heuristic on just kind of, pre-Trump era, assuming they have pretty dominant market share on like all the deals in the market, and that's like, I don't know how you calculate that, but this is like a percentage of fees. Have you done any math around, okay, well, that's in crypto, and in traditional banking, here's like all the deals that's happening in transactional dollars, and here's like Goldman, Morgan Stanley, JP Morgan, here's their take rate. So there's like this bridging of take rate because regulation opened up. Like, do you have a sense of how big this business could be for them from kind of 303? Obviously, it's cyclical.
So like I just think like there is like this one tweet that came out the other day that just showed, I think like I forget what one of the big investment banks put it out, but of the fund managers they survey, like 75% of people don't have like a crypto allocation at all. And I think like as yes, it's going to get more competitive as kind of these bigger, more traditional players come in. But the crypto market is still like pretty high take rate business just because of its volatility and its kind of infancy. So I think there's kind of those competitive dynamics will probably like play into the market share, but I think the market's just going to grow by so much that that should outweigh it. I don't have any like great numbers on that off the top of my head, but we could kind of go through even like why I think some of these Goldman projections are obviously it's going to depend on crypto, but just as we've seen in the last quarter, like I think this year into 2026, we'll have like a much better idea on like how much the business can scale, because Goldman's projecting 12% CAGR, but yeah, so this is like the global market, so trading, iBanking, net lending, but just in the last 2 quarters, or just from Q2, or so all this Goldman numbers are Q1, but just from Q2, it's like their loan book jumped 30% quarter over quarter. Their digital asset segment increased its profitability by like 10% quarter over quarter, and Novogratz said that July was like the digital asset business's best month ever by far, because like the treasury companies are starting to really pick up, institutions are starting to get more involved. I think once we have a clarity or market structure bill act passed, like we saw the Genius bill pass, which was great, and once we get market structure bill passing, that'll be like really positive for Galaxy. So, and then even on the asset management side, they're projecting 15% between asset management and then staking.
Yeah, but that's
revenue.
I mean, Goldman is like a bull posting. I mean, like they want Galaxy's business, so they're like, I usually don't rely on sales. Like, what do you feel like? Could
I
you be
feel
making
like
$1
their
billion
report
revenue? Yeah,
was
conservative,
pretty
right?
conservative, honestly, when I
Yeah,
went through it. But it's also so
yeah,
impossible. Like the digital asset side is you're kind of throwing a dart at a board in terms of like gold says like crypto prices aren't moving. It's
yeah,
going to be very difficult. Like that's going to make up way more of a delta than just like Galaxy's kind
yeah.
of like market share growth or new participants coming in. Where I felt Goldman's report was actually, so I understand like it's hard to make projections around that. Where I felt that the report was really conservative was on the Helios front, which we can kind of get into later.
Yeah.
But just another example here. They're expecting a 15% CAGR growth, but like just from Q1 to Q2, their assets under management and assets under stake went from 7.1 billion to 9 billion, which is 20% growth, 27% growth. Plus, that doesn't even account for like all the treasury companies really ramping up. Galaxy's done deals with 15 different treasury companies, and that spans from investing in them to having custody and staking agreements. So I think we're going to see another massive jump on kind of their asset management business in Q3, and then also, deploying some of these treasury company assets into DeFi could be another kind of revenue source that doesn't even exist yet. And I think that this is kind of back to like a summary of what we talked about earlier, where Goldman's highlighted that the expenses have operated in a pretty tight band between 200 and 255 million from 2022 to 2024.
Yeah.
And then you have kind of all these really positive catalysts on the crypto side picking up. So crypto prices up, all the treasury company deals, favorable regulation. I think we're going to see a big jump from Q2 to Q3. And Novogratz said July was like, the best month in the company's history by far. So I think like really Q3, Q4, we'll start to see a better picture of like how much they're really growing and how this business could be profitable in the future. Because, historically, at the low end, at 144 million, they're losing a bunch of money. At 300 million, they're making a bit, but it could really ramp here with kind of like
Yeah.
all these tailwinds.
The way I think about it, because it's like historically marginally profitable, extremely cyclical business. Like Bitcoin's down 50%, like allegedly better now. Funny enough, Moelis has a similar book value to them. Last I checked, it's like close to 500 million. They're clearing about $1 billion of revenue per annum, like way higher, way higher. Similar OPEX base actually of $200 million at a 10 times book value and maybe like 25, 28 times PE. I guess intuitively, when you it's like a really good benchmark because they employ the same equity base. Do you intuitively feel like Galaxy is a better business than Moelis?
Yeah, I think like historically this crypto business has been like very much a growth business, and like if we didn't get the administration change and all the positive kind of regulation coming through crypto, Galaxy would probably be in a pretty tough spot on this crypto business. But they've kind of
Yeah.
like made the upfront investment to build the infrastructure out, build these relationships, solidify themselves as kind of the Goldman Sachs of crypto. Um, and I think like it's still TBD, but I think like Q3 and Q4 are going to be like pretty big turning points to see, okay, was the bet they've made over the past, 6 years really investing in this business and the infrastructure around it worth it? So I think like the digital asset business, I kind of see as like a call option and the balance sheet to some extent, like a call option on just like crypto doing well, and Galaxy continuing to be a big player in the crypto market, where I see like some more certainty on the growth side, or I don't want to say certainty, but like very like more predictability, and you can model it a lot more, and get a really interesting upside case, is kind of the data center business.
Yeah.
So I think
Yeah.
it's kind of TBD, but they are involved in essentially anything you can think of crypto wise. And I think there are, some of these joint ventures or some of the new platforms they'll be pursuing could be worth a lot in the future. Like they hired Zach Prince from BlockFi to kind of like, rebuild that's not going to blow up within Galaxy.
I don't know how I feel about that actually, but that's funny. Okay.
But
It's kind of like
yeah.
in a bull market, like 'cause we're in a bull market right now, right? Like it's a bull market in the stock market, and you would argue Moelis is being valued at like the peak because the bulge aren't valued that. Historically, it's kind of a really tight band. So like 6 billion, 5 billion is the most you can give it, almost.
Yeah.
Arguably, it's growing faster. So like maybe that's the sum of the parts.
Yeah, so I think that's the idea. And if you go into the Goldman report at the sum of the parts, this may take me a second to
It's
find,
fine.
but that's essentially, they give it a pretty high multiple, and I think you can, justify that if you think crypto is going to continue to do well. But on the digital asset segment, yeah, like 6.5 billion roughly based on 2026,
Yeah.
next 12 months, but
Which is
that's
like 12 times booked. Maybe.
yeah,
Right,
so
maybe.
and that's all the that's with all the assumptions they have, and as we've seen, like Q3 is coming in like way better than expected on a lot of those numbers, but it's really difficult to kind of forecast exactly what these numbers are going to be in the future because there's so many variables. But I think just like thinking of the digital asset business as just like broad-based crypto exposure, a call option to kind of like crypto in the US and like institutional adoption here, and like Galaxy being able to continue to be like a go-to player is the right way to think about it.
Yeah.
And yeah, like it's definitely a bit of an art, whereas like the data center side becomes, a bit more predictable. But that's, I guess, how I'm thinking about it.
Yeah, because the IB side and the prop side just trades like beta, like it swings almost 1-to-1. If anything, the IB side swings even more aggressively than Bitcoin. Like it's a higher beta, in my opinion, because like you have a cost base, you could lose a lot of money because the labor you can't fire, and then the deals only happen when the market's really heated. I don't know, maybe it's a little different now. The one thing that really stands out to me in the Goldman report too is that they don't subtract the operating expense for multiple. So like aside from the 200 million cost base of Galaxy IB, what's the additional sort of OpEx that they operate at, and
Yeah.
how do you plan to capitalize it?
So I think in terms of the expenses here, so this is what you sent me, and this is like roughly
Yeah,
correct. But basically, like you annualize the labor and compensation benefits, it's around 244 million a year,
yeah,
plus
that's
all other
IB.
OpEx,
Yeah,
you know, goes into to 530 million. And yeah, I think this kind of just goes back into the fact that, it's a growth business and you're hoping to see, like pretty big growth here with everything materializing in the US. But again, it's very difficult to to kind of project that. And I think like an important point is that Novogratz, the CEO, owns 53% of the company. And like on earning calls, especially I remember back in like 2022, 2023 when I'm following the stock and it's kind of down in the dumps. He's like,
Yeah.
he's like, I'm not getting paid a big salary. Like all of my money is in the equity, and like we're buying back the stock because we believe in this, and like this is like long term. I'm gonna make my equity, or I'm gonna make my money on kind of the stock doing well. And they've obviously invested a ton. And I think you could probably say in the 2021 cycle, like people didn't expect it to fall off as hard as it did, but they probably like overhired, right? But they retained a lot of that talent throughout the cycle, and kind of retain that infrastructure. So I think it's just really dependent on where you think crypto's doing, or like where you think crypto's going, and if Galaxy can execute. I think like these treasury companies have been a massive source of like volume and customers from that, and we're going to really see that pick up in Q3. So obviously that's not sustainable forever, but in theory, like those assets should be very sticky, right? Like if they were Sailor's custodian, that's just kind of been up and to the right for a long time. And even if the premium comes down, I don't know how some of these companies are going to deal with it, but it should be like pretty long-term capital and good fee streams.
But I guess what is the enterprise value drag from corporate expense? Like what multiple do you put? Because if you're reasonably putting 28 times on the IB business on forward numbers in 2026, you put a full book value on the prop book. Is this corporate, because it's like 200-300 million of OpEx? Like, is it a $2 billion drag on 10 times? Or is it like how do you? Because it's going to run on forever when the company's operating.
Yeah, I don't know the best way to think of that, honestly.
Yeah.
I'll defer to you on that one.
Yeah.
The
I'm just
digital
guessing,
asset
right?
segment is definitely a lot of guessing, and your views on the crypto market come into it a lot. I think like in terms of personally how I'm structuring my portfolio is I was like kind of got my capital base through a lot of like altcoins initially, and kind of structured it as like a barbell between cash and altcoins. And as like crypto's matured and that market's become more competitive and more difficult, I've kind of like moved a massive portion of my crypto exposure into Galaxy, because I think that crypto in some form is going to be a really big part of the future, but it's kind of hard to find specific names to express that bet. And I think Galaxy is kind of like an all-encompassing one. And so something like this Helios is a really good example, and we can start to get into that. But basically, like, they bought that for $65 million in kind of the bear market of 2023. And, it could be worth 10 billion plus now. And that was just kind of like one segment of crypto that happened to catch a huge tailwind with AI. Obviously, less clear if that can happen to other segments of crypto, but maybe their tokenization business takes off. Maybe this all unity stablecoin reaches 10 or 20% of what Circle's worth, and they're doing like European equity settlement through GK8 and tokenization, and then also have this big chunk of this stablecoin business that they own. And maybe they build out a retail product or a lending product in the future that could be really big. It's kind of hard to see necessarily where the growth is going to come from, and I think that there's going to be a lot of new business lines in the future that Galaxy's been investing in for a while that just like haven't even started generating revenues yet.
We're gonna go into Helios in a second, because I feel like that's the most exciting piece of the business.
For sure.
Because the remaining Galaxy, at least in my opinion, it is a bloated cost base that underperforms crypto as a whole historically. Like, you're better off kind of just owning Bitcoin without paying the management fee and the cost drag. The sum of the parts that I have without Helios, for instance, is like $2.5 billion prop book plus $500 million of book value, like as you indicated. the book value of 2.5 billion at 400 million shares is like $6 a share, $6 to $7. I think we can reasonably give the IB of Galaxy like a high, like 10 times book value, right? So that's like $15 on the sort of $500 to $600 million, right? That's like a 5 to 6. It's like same size as Molus, and that gets you to like $20 of core Galaxy. Except the problem is there's this $200-300 million of OpEx base that exists. I think it's just unreasonable for Goldman not to account for it. I think it's wrong, actually. So you capitalize it on a low ball, I don't know, 10 times earnings, like whatever that is. You subtract $7, 5 to 7. So like basically core Galaxy, like where the stock is today, 26 to 30. I think there is like maybe 10 to $15 of core Galaxy that's in there. And then there is like 10 to $15 of Helios that's in there, at least in my opinion. So
Yeah.
I think that means the market is already baking in, like, I don't know, call it like a couple $1 billion of Helios. Am I like crazy to frame it that way?
I think that is a reasonable way to see how the market's assuming it. I think like, yeah, $15 of kind of core Galaxy plus like a big out of the money call option on just like crypto doing well is how I would kind of think about the balance sheet plus like the digital asset business, and then Helios is where things can get like really exciting. And I personally think Helios is worth, if they continue to execute, a lot more than that kind of like $10 a share. I think Galaxy's trading around 26 right now. So happy to jump into that.
Yeah, let's do that. I think there are some really exciting developments recently too. Why don't we start with for all of the viewers, they should probably already know of the 800 megawatt that is already baked. There's like $2.5 billion plus that's like in the works. All of that costs capital. There's a cost associated with it. But in that first tranche of 200 million, there are some positive development. Why don't you walk us through initially of just that 200 million, kind of what's happening, how much cash should it generate, how much is already plowed in, and so on and so forth.
Yeah. So basically, to just kind of frame up Helios at a high level, you have, Galaxy acquired Helios from Argo Blockchain back in 2022, 2023, and like kind of the bear market for $65 million, and they had 800 megawatts of kind of approved power. And now in this AI race, what we're seeing is a massive bottleneck being kind of like readily available power at this scale. So very attractive for kind of these hyperscalers or a company like CoreWeave to come in. And there's been kind of like a lot of deals happening between some of the Bitcoin miners and these hyperscalers to kind of, redo these Bitcoin mining data centers into, AI data centers. And so far what Helios has signed is their full 800 megawatts of approved power has been leased out to CoreWeave, and they're projecting that to bring in 1.2 billion a year in average annual revenues over 15 years at kind of these 90% EBITDA margin levels. And the EBITDA margin levels are so high because they're flowing through essentially all costs to CoreWeave. And this revenue is going to start to come online in tranches between kind of the first quarter of 2026 and 2028. In terms of the positive developments, so they're basically breaking this out into three phases. They have like 200 megawatts phase one, 400 megawatts phase two, then another 200 megawatts as phase three. So in their last earnings call, CoreWeave upsized their lease from 600 to 800 megawatts, taking all of the approved power. And then Galaxy just this week secured a $1.4 billion debt facility to help build out phase one of Helios at around a 9% interest rate. And then what I thought was a really positive development on Helios here was that the loan is just secured by like the assets related to Helios phase one. So they're not kind of putting their balance sheet or broader business in jeopardy. And I think that shows like a big or like a lot of confidence that they'll actually be able to execute on this. And then the other thing that they announced was during their Q2 earnings, they they bought another plot of land next to Helios and expanded their power pipeline by 1 gigawatt. So now they have 2.7 gigawatts under study, plus the 800 megawatts approved for a total of 3.5 gigawatts, which is a lot of power.
Yeah, that's a lot of power.
The current estimates of data center capacity from McKinsey in the US is around 50 gigawatts. And then the range of what that's going to grow to in the next few years is highly variable depending on who you talk about. But, these hyperscalers, I think just between Microsoft, Meta, Amazon, and Google are spending $330 billion a year in 2025 on CapEx and expecting that to ramp into the future. So insane investment from these hyperscalers and big tech firms into AI data centers. And one of the massive bottlenecks is power. So to give you a sense, I think even in like a very regulatory friendly environment, Texas has their own power grid as well. Lead times, like if I were just to snap my fingers and make a data center in Texas right now, it would still take 2 to 3 years to get power online in Texas. And then in somewhere like Virginia, where kind of like the data center 1.0 world was, it's something like 4 to 7 years to get power online. So power is a massive bottleneck. And the fact that Galaxy already has this 800 megawatts approved is huge. Plus, management has guided towards an additional 800 megawatts being approved kind of by the end of the year. In the past few earnings calls, they've said like single digit months. They also have this new board member, local Texan, Doug Deason. And so, Novogratz flew down to Texas the other week, met with, the governor of Texas and like all of the regulators. I think that Galaxy is like the largest employer in the county in which Helios is. And so they have some like pretty sweet deals in terms of like tax deals there. And, the town loves them. They've done a lot for the community. So the big like upside to Galaxy, which, in the Goldman report, they're not really forecasting, is because, it's kind of hard to say they will get these approvals.
Show us the math you did again. Yeah.
Is if this pipeline does come online. So just for instance, if we look at the Goldman report, and I really don't know why they did it like this. I don't think it makes any sense, but maybe it kind of balances out what you would consider the moon math on their digital asset business. But essentially, if we bear with me here to find this again.
Because it really seems like they're just doing like phase 1 completion plus like part of phase 2 into the EBITDA.
Yeah, exactly. Yeah. So they are, and there's some of the parts, they're pulling this 221 million EBITDA number, which if you look how they even say it's going to scale themselves and what management has guided to is by 2028, it's going to be around 900 million in EBITDA that they're going to be generating. So they pick this weird point in 2020, between 2026 and 2027. So it's like phase 1 completion with a little bit of phase 2. And I've kind of made a model around this. But basically, so these are Goldman's numbers here in yellow, which is this weird point in between 2026 and 2027. But if we just go through, so they already have these 3 phases contracted out. If we just take 2028 estimated numbers on that, then you're getting...
assume they're on schedule, right? That's the guidance. By year end 28, everything will be online of the 800 megawatts.
So that's 900 million in EBITDA. You apply their same multiple. You're looking at, they have an enterprise value or an equity value of 3.3 billion versus 18.3 billion here.
And to fully get there, sorry to cut you off, like to fully get to 800 million, how much equity do they have to put up? They have already put up like 500 to 600.
Yeah, so their total development costs are basically like these numbers summed, and then so I think it's about like 6 billion or the total sum of these numbers we should be able to get. Yeah, $7 billion roughly.
Yeah.
And then they're funding that 80% debt, 20% equity. There's also like different ways they can explore funding that equity. A potential scenario is once phase one is online, they can then do kind of a borrow against the future cash flows for phase
Yeah.
one.
Yeah.
They could also, sell part of phase one to like investors who want data center exposure. They could, take in some outside equity for the next few phases. I don't think it's basically the bottom line is they have a lot of flexibility in how they can fund the future build out. I don't think it's
Yeah.
going to result from like, dilution of shares beyond what's, convertible notes that are existing and such.
Yeah.
So, if you, and then Goldman uses a 12% discount rate. So like if you discount out this 2028 stuff just to today, you're talking about, nearly $12 billion for just this first 800 megawatts that they have approved and leased out, assuming
Yeah.
they can build on time and everything. So that's like 30
Yeah.
bucks, which is more than the entire share price. Where
Yeah.
things get like nuts, and I haven't even added in the additional 1 gigawatt of pipeline that they have, just acquired in last earnings. But, in 2030, let's say they build out their next 800 megawatt tranche and get that leased out to a hyperscaler, you're talking about the EBITDA going from 900 million to nearly 1.8 billion a year, applying the same multiples, doing all the same math. That's like $92 a share in 2030. Discounting that back to today is a lot.
Yeah.
Obviously, you're getting pretty far out here, and then when you do the next 900 megawatts, $145. If they get another gigawatt, the numbers start to get really insane on this front. And then just to
Yeah.
kind of like tether this back to earth a little bit, if we go to a tweet that Rittenhouse has posted in terms of kind of like other data centers. So basically you have a company like Digital Realty, which is the best comp for Galaxy, and so they do around 3 billion of EBITDA and have an enterprise value of $75 billion, applying this like 25x multiple. And then there's a lot of nuances where like you could argue that the Helios site and their numbers are going to be just like a lot more free cash flow than Digital Realty, and kind of just a better business model. But you could also kind of argue on the kind of tenant concentration risk. But this is like, a company, Digital Realty, their data center kind of 1.0. So they have, I can't remember if this is Digital Realty or Equinix, but they basically have, around 3 gigawatts of power across 300 sites. So you're talking about an average site of like 10 megawatts. And then they'll rent kind of, 1 or 2 megawatts out to specific companies on kind of shorter leases. They still have to maintain some of the capex, and like not all the costs flow through. So it's not quite as attractive. And Galaxy has, potentially 3.5 gigawatts at one site, probably with like 3 or 4 massive tenants, where they, if it's structured the same way as kind of the CoreWeave lease, are responsible for all the costs associated with that. And so you're talking about a much higher kind of like free cash flow on this site. So this is the big opportunity where, if you frame it up, I have a tweet. I probably won't be able to find it very quickly, but basically, like amongst all the hyperscalers, it's like, okay, the biggest site announced is Meta building their something like Hyperion facility,
Like a one gigawatt. Yeah.
Yeah, so it's like 1 gigawatt now, but they want it to be 5 gigawatts, and that's like big tech company, like massive site. And then kind of like Microsoft, Amazon, and Google, like they're talking all on the range of like a couple gigawatts. So Galaxy's Helios site is like right up there in terms of, the magnitude of sites that these big tech firms are building on. And the real like growth scenario here for Galaxy and where they could differentiate themselves a lot is that this like data center 2.0 business is completely different than a data center 1.0. You're talking about 3 gigawatts across 300 sites, a couple megawatts a tenant, and then with these you're talking about multi-gigawatt sites with just a few tenants, arguably a lot better economics. And if Galaxy has the balance sheet and, develops the relationships with the hyperscalers and the developers, they're working with like a tier one developer in Texas called Clayco. If they continue to like expand their power pipeline or maybe do some joint ventures or acquisitions in the space, it could be absolutely massive. Like we've just seen them acquire a whole other gigawatt of power pipeline, in the last quarter. So if they continue to really like lean into this side of the business and are an established an established player here, I definitely think you could see them, reaching a Digital Realty or Equinix like kind of market cap, which these guys are on the order of 50 to 100 billion. So that's a 5 to 10x over some period of time, just on the kind of data center side alone, if they continue to execute and grow that business, which is pretty exciting.
So I have a couple of questions. That's a pretty comprehensive overview. I think we all get the moon math, which is like if they fully build out the site. And I think the first one we have to take into account is that all of the equity put in is upfront. Like from all the moon math I've seen, nobody accounts for the equity that gets put in. Like they always put a 27 times EBITDA on the EBITDA in whatever years, and then to subtract the debt they assume that will be, and then that's the price target. It's discounted back at 12%, without accounting for the billions of dollars of equity they have to put down ahead of time. That is like arguably changes your DCF math, but that's like small numbers. I have a couple of questions around the fringes. One is the cost of build out, like right now is $12 a megawatt. One. And then two is the price that they can charge, which is right now 1.6 million per megawatt on EBITDA. Do you feel like those numbers would change, materially a couple of years down the road?
Yeah, so I think that right now, like it's very hard to see. It seems like these big tech players are essentially saying whatever we need to pay to get compute online.
Yeah.
And, CoreWeave, obviously this is a 15-year contract, so that's pretty long. I think that if they're to get, let's just say, this next 800 megawatts approved by the end of the year, they'll have it leased out at kind of very similar terms to what the current CoreWeave lease is.
Is that the guidance? Is that from talking to the company? Yeah.
Yeah, the guidance seems to be that. Yeah, so like I think that the things to get it approved are essentially like kind of multifaceted. Basically, it's like, when did you apply for this power? Can you actually execute on building this power out? Will you use the power you say you're going to use? And then like, do you have like, the relationship with the county and the state to like, good relations there to actually get this done. And I think in terms of like the positive camp for Galaxy, they actually applied for this additional 1.7 gigawatts. I think Argo applied for it back in 21, 22, which was pre the data center boom. So in terms of just like that data point in the queue, they're going to be very high up. They have, the balance sheet or the ability to actually build out on this. They have the relationships with the hyperscalers. They have the relationship with Clayco to build the site. So I think that they're in a pretty strong position there. There's some other Bitcoin miners who kind of say like we have, a couple gigawatts under study. And then when you actually go look at the site, it's like there's fucking nothing there. And they applied for this way later. And then there's also like the switching stations and the transmission lines and like the diesel generators, like all this stuff is like very kind of long lead time. And when you look at Helios, it's like has a switching station right next to it. ERCOT's planning to build another one very close to it. So they have kind of like all these things lining up that are like multi-year lead times in advance, where like Helios could actually like, it's pretty realistic that they can execute on at least a big portion of the 2.7 gigawatts they have under study.
And why do you think CoreWeave picked Helios versus like Iron and TeraWolf and all the other guys that are not sort of under contract?
Yeah, so I think like that's also a multifaceted answer. But basically, I'm pretty sure Galaxy was providing some sort of financing activities to CoreWeave back when they were like mining ETH with GPUs or some sort of relationship there. They were part of their IPO. So they obviously have deep relationships with CoreWeave that kind of precede all this data center stuff. So that's one point. Brian Wright did a good podcast on the Bitcoin mining podcast, who is kind of like the head of Helios, and with Will Foxley, who runs that. And they basically said that they had like CoreWeave and other hyperscalers come and check out the site. I think like CoreWeave was just the most comfortable with Galaxy and like understood their business and like knew that they had like a strong management team and the balance sheet to execute. And I think when a lot of these other hyperscalers are looking at these Bitcoin miners, they're like, these are just like kind of shitty
Yeah.
companies that have
Yeah.
won the lottery. They don't have the balance sheet to build this out. The management teams are kind of crazy. They've diluted their shares 400% over the past few years. And we're starting to see more deals come online, which I think one speaks to kind of like the desperation of these hyperscalers to kind of secure more power. But I think Galaxy is obviously like in that space of the Bitcoin mining world, and the Helios site is kind of like a tier one person to partner with, relative to these other Bitcoin miners.
I
And
see.
Galaxy's economics are also much better because they can like front the capex bill, where like a lot of these other deals you have to have like, you know, a third party come in and kind of guarantee the capex, or the hyperscalers
I
paying
see.
for some of it, so they have like less leverage in that sense. So I think Galaxy's at like in a really good position here.
I see. So if I were to summarize, it's kind of like the potential customer look at them and say, okay, these guys can fund the whole thing because there's like $2 billion plus a book value.
Yeah,
That's not going to go to zero. And then it's like, well, Novo is not a complete piker, right? There's actual potentially real compliance in a shitty crypto industry nonetheless, but they actually do things by the books, right? Listed company for a long time. And all of that things combined make those, you know, CSPs, aside from building it themselves or doing the pure plays like Equinix, kind of just like, it's like Galaxy is a viable option for them. Is that
yeah, I think that's exactly it. And to this point, Rittenhouse had this great shout out on Meta's you know, latest earnings, where they're planning on contributing $2 billion worth of data center assets into a co-development vehicle to offload part of their capex bill to a third-party data center provider. So, you know, Meta's free cash flow has declined from 24 billion to 20 billion this year, even though they've grown their EBIT, you know,
Yeah.
at 20 to 30%. So it's like, and you know, when you look at the capex bills that these guys are spending, like I said, between Meta, Amazon, Microsoft, and Google, just those four companies, it's like 330 billion a year. It's like they are throwing an insane amount of money. And not only, you know, is the data center build out expensive, but getting all the chips is extremely expensive. So I think like a lot of these hyperscalers are, you know, they don't want to put up this like massive equity to build these things right now. They're more like, what they care about is the compute. So if they can kind of like enter into these rental agreements, spread that out over long periods of time, not have to pay for all the capex, they're, you know, very interested in exploring that kind of avenue.
Do they, because for the full build out, they need like 1.4, 1.5 plus of equity. They have already funded kind of half of it. Are they going to self fund the other half? One. And then secondly, are they going to redeploy the free cash flow generated from this 800 megawatt into more data center capacity?
Yeah. So basically, you know, so for phase one, they have that funded. I think it's like 350 million of equity that they put in, and then they have this $1.4 billion facility. I think like in terms of options for them financing the rest of the build out, you know, this is an example. So it's coming in a bit higher than 1.6 billion to build. So it's like these numbers are 350 and then 1.4 billion. But so it's going to be generating 220 million of EBITDA. So they can lever that up, you know, 8x. So take out, you know, 1.8 billion against that to kind of fund future development. Or you could sell like 25% of phase one to kind of fund future phases and you know, get that big equity base. They could also, I think, like do like a co-development vehicle where they like get some of these like I'm blanking on the name, but like Brookfield or someone who wants data center exposure. Like, okay, hey, do you want to pay for like a few percent of the equity, and we'll sell you a few percent to just kind of like spread out the cost. So they have a bunch of different kind of avenues they could go here. On the
And
net balance,
Galaxy owns, sorry to cut you off, and Galaxy owns 100% of Helios today.
yeah.
So they could
yeah.
race for this.
Yeah. So they have a lot of different options here. And if you think about the balance sheet of like $3.2 billion net, like 2/3 in crypto, 1/3 in cash, they still have like $1 billion plus in cash that they could use. So they have a lot of flexibility in how to make this work.
And I guess the CoreWeave funds all of the operating costs, and they fund also the maintenance capex.
Yes. Yeah.
Okay.
I'm pretty sure.
What do you think is the most likely to happen? I guess it's not a fair question, but like people can kind of see the Equinix and the sort of dollar royalty business down the road, so they don't ever ask this question. But when you have one contract like this and it's like a 15-year lease, if you run the DCF, it's like 15 times EBITDA, and you have to assign some terminal value on this kind of whole site. How do you feel about that terminal value when the lease is up for renewal? It's not a fair question because it basically is a question of AI 15 years from now. But like, I'm curious if you have a heuristic.
Yeah, I think so. I was talking to Rittenhouse about this, and I'm trying to find. Yeah, so this is basically his answer. It's
Okay,
like
he doesn't. Okay.
yeah, it's basically like the residual value is going to be very difficult to because between the AI data center 2.0 and like why the like Digital Realty and Equinix are in a tough situation is like they have all this power and like at a quick glance, it might be like, oh, let's buy these data center companies because it's going to benefit from AI. But it's like not at all how these sites are structured. And the thing that we're like, Galaxy's actually in a really good position versus like having this all built already. If they could snap their fingers and have it all built, obviously that'd be amazing. But they're building out like a completely bespoke data center for CoreWeave according to their specs and whoever CoreWeave's customer specs are. So like it's a complete custom product. And it's going to be really hard to know, 10, 15 years down the line, what the newest data centers being built at that point are, or like what kind of the, top spec is in terms of like, does the rack density change? Like, is there like a new method of doing things? Like, it's just very difficult to know. I think on what Goldman has said is they think that, they're depreciating the data center at a life of like 20 years. So, an extra 5 years on the contract. I think that this is going to be very difficult to kind of project out into the future.
Interesting. What other executional risks do you think people are baking in? Like aside from the obvious one is delays, right? There are other obvious ones such as, a financial crisis in the interim. In the end of this, I want to talk through like kind of how the whole plays into kind of different scenarios. But like, are there any other executional risks that keep you up at night, keep them up at night?
Yeah, like I think No Regrets had this funny quote or like this funny thing he said on a podcast where he's in New York, and I guess we didn't know who the developer was at the time, or the person building the data center was at the time, but Clayco, I think maybe the CEO of Clayco or something was going to be in New York, and he's like, hey, like, No Regrets trying to grab dinner. And he's like, are you kidding me? Like, you're the most important person in my life, like, other than like my wife and kids. Like, of course we can get dinner. So I think just, building this out on time, on cost, having no big issues there is really the risk moving forward. And then also getting these power approvals. But in terms of mitigants to that, Phase 1 seems like it's on track to come online in Q1 2026. So that's all looking good. And then I forget what.
The 400 megawatts ones brick sites now, it seems like they should start funding the equity on that side.
I think like the timeline for that is in this. Like when do they expect that to be the full revenue date? So that's not till the third quarter of 2027. So 2 years from now.
I see.
So it seems like, the build time is maybe a year and a bit out. And I think like, so once Phase 1 is kind of starts to cash flow, they'll probably start doing the construction there. And then like kind of as they have the stronger base of cash flow here and maybe are more established, then they could potentially accelerate the timelines on, these next tranches and the next gigawatt afterwards. But I think like right now they're focusing on just like, okay, can we build this data center to CoreWeave specs on cost, on time? Once we're confident in our ability to do that, then maybe we can start accelerating these timelines on kind of the future phases and tranches.
Yeah, I think we can debate the multiple, but it's kind of I mean, who the hell knows really? Because it's a really he say she say about kind of the quality of cash flow. To sort
Yeah,
of,
I think that like this is some pretty good color around why the multiple makes sense. So basically, this is just comping Helios to digital really and Equinix and kind of like the pros and cons here. Again, thank
yeah,
you, Ritmos, for helping on this. And so, so the EBITDA should convert into a much higher free cash flow, just
yeah, it's kept
because.
light. The capex is funded. I get that.
Yeah,
It's growing faster with pure play flow through. I get that too. I suppose I think the Equinix guys would argue there's like additional fees beside from just basically wholesale electricity contract of like all the platform fees and ARRs, and these things are baked like years in advance. But I think it's a bit of he say she say. I guess the question I'm going with this is: are there any other transactions in the market recently that confirms this 25 to 30 times EBITDA figure? Like, are there
yeah.
any transactions that Facebook purchased, Microsoft purchased? Because they could just fund it themselves. They don't have, but like, if somebody bought this for like 25 to 27 times, I think it'll be a pretty, yeah, go ahead.
Yeah, so these are kind of like some historical comps, but it's kind of hard because like these are all new,
Pre-AI.
right?
Yeah.
But like I guess like 2024, this isn't, you know, Blackstone acquired this at a 26x multiple. It's 800 megawatts. Um, you have some pretty sizable facilities here. So, you're talking about 26 all the way up to like, 33x multiples, or 35x multiples on some of these sites. And then
Is
also,
AirTrunk for AI or no?
I don't know. I'm
Okay,
yeah,
okay,
I'm not
okay,
familiar with
okay,
the exact sites,
okay.
but I think like going through kind of just these answers, just on kind of the pros cons. Yeah, so we just talked about this. The free cash flow should convert at a much higher multiple, and then these digital relay and Equinix, actually have this like capex greater than EBITDA. A lot of their contracts aren't structured the same way where they flow through all the costs of the tenants. And they're not built for AI, so that's one argument there. Yeah, so like Helios should grow at like their Galaxy's data center business should grow like much faster than DLR and Equinix just because they have these like 2.7 gigawatts in the pipeline that could come online. Helios this is purpose built for AI versus Digital Realty and Equinox are kind of these data center 1.0 sites, which they can't really like convert this into AI. It's not really the same thing, or if they're going to, it's going to be extremely expensive. And then Galaxy's one tenant right now on a 15-year lease, versus DLR and Equinix have thousands of customers on 3 to 5 year leases, constantly need to find new tenants, upgrade their older facilities. Way more operationally intensive. Their occupancy is only 80%. So like 20% of their capacity is just like sitting empty, which kind of suggests that like it's not available for AI workloads, and also they're forcing other pressures from potential customers like a JP Morgan or Coca-Cola shifting their IT spend to kind of these public cloud vendors versus needing to go directly to DLR for a few megawatts for whatever their like IT and cloud spend is.
Yeah. It's funny because I remember studying history, and there was like a period where the fibers were getting laid. And it was very clearly the fibers were the future. And you have like these like moon math numbers in 99 and 2000. And then like if you look at Equinix's chart, it like pumped and then like it giga dumped and then it kind of pumped again to all time high.
Yeah.
You kind of see a rerun of this because people kind of saw this as the future, and there's like an arms race going on funded by Wall Street to like just really go hard at AI, which kind of I don't know. This has kind of become an open discussion at this point. Like the way I think about this is, if I run the math of the cash need and when the cash flow actually comes in, like I fully buy into maybe in 3 years time, this thing trades at 27 times EBITDA. It could. And at that time, what's the EBITDA? It's like $1 billion, right? It's a lot.
Yeah.
A billion
Yeah.
plus, right? Okay.
2 or 3 billion. Yeah.
Yeah, well, let's say year end 28. That's when the whole thing kind of comes
Yeah.
online
A
and they get the
billion.
pricing, and then
Yeah.
you can slap and then you subtract. But once you, it's like $50, kind of a share if you run the moon math. I suppose I expect that price target to be realized closer to that 2028 mark versus today, right? The discount rate US is higher and all the cash spend is in front. And people are sort of already starting to bake in two risks, which is one, the cycle risk of crypto. Like you could be completely right about this data center build out. But if crypto goes into a bear market, they'll be bleeding cash from all orifices and their prop book will be down a lot. So how do you fund this thing? All of a sudden, this AI center becomes a risk. And the second thing is until the EBITDA comes on, there's always questions about execution. So I feel like people are assigning a really high discount rate to the story because of the path dependency based on the cycle and based on the capital market being open. They need to borrow a lot of money. So, do you feel like I'm misplaced in my skepticism? Like, do you expect this thing to like reprice immediately, or is it more like a 27, 28 story?
Yeah. Like, I basically think there's a few key catalysts that should help pull forward like kind of those attractive numbers to today and like have that show up in the stock price today. But basically, this debt financing for phase one was a huge one that they just announced. So it's like, okay, there's actually someone willing to lend us to build this out. Obviously, the lease with CoreWeave was big. And the next thing is kind of, making sure phase one comes online on time and this like Q1 2026. Like once it starts cash flowing, I think people will be like, oh, fuck, like this is actually real. And then the second one is, I'm expecting these things to happen around the same time, so phase one comes online, starts cash flowing, and then they get further approvals on this like 2.7 gigawatt pipeline. So if they get, let's say by Q1 2026, they have another 800 megawatts approved and then leased to a new tenant like an Oracle or another kind of like big tech hyperscaler, plus like financing secured for phase two, all of a sudden it's like, okay, like this is really happening and you can start to pull forward these numbers. So that's kind of what I think is going to happen. I think Galaxy right now trades a lot like kind of crypto beta, and this is obviously like a massive upside case, but like the market isn't quite, maybe understanding the full story or necessarily believing it. Plus you just have like this kind of messy balance sheet plus digital asset plus data center business that's a little bit hard to kind of wrap your head around, right? Like it's not an easy story to fully understand. Like the Helios on its own is, quite clear, but when you add in all these other things, a lot of times these kind of conglomerates can trade at a discount because it's just not clean. So I think like another thing they could do is maybe in 2026 like spin out Helios. And I think that Novogratz has said if the market doesn't like, in his view, give them like a fair value in a year from now, then that's definitely something that they're gonna like consider quite like
A year from now, mid 26.
Yeah.
Interesting. Because that's another question. It would seem like phase one needs to be rock solid to show people you have EBITDA. You need to load this thing with like basically a yard of cash, hopefully. It's like clean. Maybe before that you sell some of it to a highly strategic player, like sell some to Meta, like doesn't matter. And then you spin this thing off once it's like it can stand on its own with free cash flow.
And that's where I think it's like, okay,
maybe that's a catalyst.
This is a very pure play AI data set. Like you're essentially buying like one of the biggest data centers in the US, potentially. A very pure play with like leases already going in construction, like they've proven they can execute. And that's where I think like things can get really crazy. But like, personally, when I bought Galaxy was during the whole tariff meltdown and it traded down to like $8 US. And at the time, okay, the balance sheet instead of being 3.2 billion is maybe like 2 or like high 1 point something. And then you're looking at so that's maybe like $5 a share. And
Yeah.
then you're like, okay, you're telling me the crypto business plus the data center business is not worth at least 10, $15. And at that time they had just announced they're going to be uplisting to the NASDAQ. They had this 600 megawatts contracted with CoreWeave. It's like, that's a very, like, that's an example of just the market just completely discounting everything and like pick it up for nothing. I think obviously the market's bounced back a lot, but I don't think it's like really kind of pricing in what Helios could be.
Yeah.
And that's just like a data point where people are like, oh, how is the market not price this in? I'm like, well, this thing was trading at $8 4 months ago. And
Yeah.
like no one was pricing anything in at that point.
Yeah, I just thought people look at the $1.4 billion that's needed to fund this Helios thing, and they're like, fuck, that's your entire prop book. So if you plan,
Yeah, well,
you see what I'm
but
saying?
it's
Like,
yeah, but like the thing is, like they have this 80% project level financing that's like ring fenced specifically. The collateral is that site. It's not the whole business. So it's really just like 20% in equity needs, and then once they start cash flowing, there's just so many different directions they could take it to kind of fund the rest of the build out.
I think people kind of want to see the first site. I just feel like there's a lot of crypto-driven cyclicality in this. Not just the whole core business flips around, but that the ability to fund this thing before Site 1 comes online could be in real jeopardy if the capital market shuts down for a liquidity crisis.
It seems like it's secured now for at least phase 1.
It's a lot better now. That's probably why it trades up. But like you can imagine a future, like even at this point, we're going to financial crisis. Like crypto is down a lot. People question their ability to like fund this thing. That market could be closed to them. And then it's like, what do you actually still believe in the future of Helios?
Yeah, you definitely have to be bullish on kind of AI and the capital markets being open for data centers. And I think like, with how much money these big tech companies are throwing at AI, I think that's pretty high level of confidence and just the progress we're seeing there. So there's obviously some risks here, but I think like the upside is pretty attractive, especially versus like, if you're a crypto investor looking at buying like Bitcoin here or this, which is like, this is, broad-based exposure to crypto. If Bitcoin does well, the stock's going to do really well. And then, you probably have some cushion on the downside with, Helios doing well. And if you're bullish AI as well, like, it's very good exposure in that sense.
Have they talked about going into like investment banking related stuff with the AI companies?
Yeah, so obviously they were part of the CoreWeave IPO. I think that, maybe for the Bitcoin miners, they could kind of, potentially be an investment banking partner. They have said on they did like a spaces after their Q2 earnings, and they're like, our investment banking pipeline is like the highest amount in dollar values we've seen in like ever, and also quality of names. So I think that there could definitely be potential for that. I don't have any direct visibility into kind of future customers there.
Anything on Helios that we haven't touched on yet you feel like we should cover?
I think that we did a pretty comprehensive job of going through this, and kind of, I'm obviously representing a bit more of the bull case, and you're giving a very good argument on kind of why that might be the case. But I still feel like pretty confident, I feel like after kind of going through everything again and taking a deeper look at the digital asset business, like I feel even more excited about Galaxy than I did like kind of going into this podcast or post the Blockworks podcast. And I think like a big point on like the execution side is, the management company and this is why I have like some comfort after following them for a while, is they've kind of like done everything they've said they were going to do. And I think that, inspires a lot of confidence, and they seem to be like completely on track and kind of exceeding expectations on the Helios build out thus far. And I also just think like the market doesn't understand it. A great example is like when they released this $1.4 billion financing.
The stock dipped. Yeah, it's
Yeah,
funny.
the stock traded down that day, and I think that was mostly it was like Friday OPEX, like a lot of open interest. They're still kind of building up their liquidity base on the Nasdaq, and it's like in no way was this bearish news for this stock, right? Like the interest rate came in kind of better than what management was guiding to. The loan is secured by just Helios itself, not it's not like putting the bigger business at risk, and it's like a great step in the right direction. And I think like just like crypto markets and crypto equities were down that day, and it just like traded poorly. And so like that's just another data point where it's like I'll sometimes see this thing down like 10% because like Bitcoin's down a few percent or whatever. I'm like, they're missing the big story here, which is Helios. I think just kind of gives a bit of insight into how the market is viewing this, and it's really not taking into account Helios.
Well, to be fair, it's a bit of a timeline mismatch, right? Because this is the Helios thing is a 3-year story, and it's like milestone based, like step function type upside, whereby at any given point, like crypto shit in the bed means that Helios future, they need to find other ways to fund it. Or like there's a risk of like, can you actually get?
I don't even now that they have phase one secured, it's like okay, phase one in Q3 26 is going to be generating 220 million of EBITDA, and it's like just from that you could probably fund a lot of the equity from like into the next stages either by selling a portion of it or refinancing it out. Like
Yes,
there's a lot of options there.
that makes sense. I just thought the IB and the crypto it's like
Yeah.
it's like a greater than
Definitely.
one beta asset,
Yeah.
and then your core Helios doesn't move all that much. So if your crypto thing is greater than one beta and crypto is down, like you should be down quite a bit.
I really think that kind of end of year, like if by the end of the year or kind of like Q1 2026, assuming everything goes well with phase one, and like the stock hasn't really, or like kind of the market hasn't really recognized Helios, like I have no idea what's going on. Like something is wrong at that point.
Yeah.
Right. I can understand now why.
Yeah.
But
I
like
think
once you get to that point, it's like, what is happening here?
I suppose if it doesn't trade up at that point, like people are assuming a pretty bearish future for crypto. Like it's like, oh, we're going to bear market. One.
Yeah.
And then two is like, maybe the AI craze has faded. Like Nvidia could be down 30% for whatever reason. I have no idea. And then like there's discussion potentially circulating about like, is CoreWeave okay? And then it's like, well, what about the 15-year lease renewal down the road? Like, should it trade at 27 times EBITDA? Like, if the AI craze kind of the arms race pull back at that point, like, I could see this asset not being as sought after.
I think that's where you have to like just look on this as a relative basis versus what you could invest in today, right?
Yep.
Like if you're bearish crypto and AI, then don't buy the crypto AI stock. But if you have a decently positive outlook on those things, I think like Galaxy is a really attractive way to play most trends, and I think that it'll outperform the crypto markets as a whole, and certain AI plays. It's kind of hard to see there exactly how that plays out, but it's pretty attractive. It's kind of like the data center business, kind of like the picks and shovels of AI, right? Like it's you're not betting on a specific company to monetize their AI product, but you're betting on just like the whole industry growth.
Yeah. Makes a lot of sense. I don't have any other questions unless the group does. Very exciting. I could see this being $40-$50 in like a year or 2 years time. Milestone based. And if crypto trades higher, it just works. And we haven't even touched on like the perp, like the stock perp upside, because they're like primed to capture that market. And there will be a lot of just opportunity as SEC regulates.
There's just so many things you can't even really bake in that's like embedded in like what you said, maybe $15 a share for the core business plus like a out the money call option on whatever crypto or tokenization kind of turns into.
Cool. Awesome.
Yeah,
Duncan, thank you so much for your time. This is great.
Yeah, no, thanks for having me on. This was great, and yeah, you asked some hard questions, but hopefully I gave some satisfactory answers.
That's great. And again, people can find you on Twitter if they want to jam more. You're very responsive.
So definitely follow Rittenhouse Research. great page. You know, this is my Twitter account. There's also this one guy that I definitely need to shout out, who's really on top of. So yeah, so he's like always looking at like satellite photos on progress for Helios.
Cool.
He's consistently scouring the job board, like, oh, they hired these people, and whatnot. So he's very kind of up to date, interesting kind of nuggets on Galaxy. So definitely those two accounts, give them a follow. And yeah,
Thank you for your time.
thank you. Thanks, Jason.